We're going to continue with this discussion of the Greek exposures. We've looked at delta, we've looked at gamma, we're now going to look at theta. We'll remember that theta, the T of theta, reminds us that we're talking about sensitivity to time passing. So be careful. It's the impact of a day passing, which is always going to be negative if you're holding options. So if you're holding options, this is kind of like a tide that you're swimming against. In general, time runs out, time value goes down, and that's a negative if you're holding that long option position. Of course, it's a positive for short option positions. All else staying the same, and time just running out means time decay erodes the value of the option, and the short side will benefit from that. Now, just a little bit more detail on what types of options tend to have the most sensitivity to time passing. Theta is going to be highest in absolute value. Don't forget it is negative for long option positions, but it's going to be highest in absolute value, size, not sign, for at-the-money options. This is because at-the-money options generally have most time value. It may not be immediately obvious, but in previous modules we have actually already seen that. When I've sketched, for example, a call option's value like this, don't forget the implied axes are underlying asset and value. When I sketch a call option like that, that is actually the value at expiry, that hockey stick, that's a long call. You'll remember that value prior to expiry, we said, well, it's going to trade on a curve which kind of rests on the blue line. Blue line, there's no time left, but the red line, there's some time left, like a month, something like that. So the difference between the blue line, which is just intrinsic value, and the red line, which is the option premium prior to expiry, it's a long call prior to expiry. The difference between those two is time value. And as you can see, time value is maximized when we are at the money. Just to be clear, we're out the money over here. On the call, we're in the money over here, and we're at the money when the underlying is close to the strike. Don't forget the strike is always where lines change direction. And time value is highest when we are at the money. And it's to do with the fact that that's when there's most uncertainty about whether the option will actually be exercised or not. If you sell in the money options, you can prepare to be exercised against. There's not a lot of uncertainty there. If you sell out the money options, you can have a high degree of certainty that you're not going to be exercised against. But it's without the money options where we just don't know. So that's where time value tends to be maximized, and sellers of options need the most premium for what could happen in the future. So yes, that's why at the money options tend to have highest theta, because as time passes, they've got the most time value that will erode, in absolute terms, will erode the most. You know, if I let time pass on this chart, that red line, maybe that's a month to go. If I let a couple of weeks pass, maybe there's only a couple of weeks to go and on the option, and it will be trading on this green line. So there's less time value overall, but the biggest falls in time value have been for those at the money options there in the middle. Okay, so yes, at the money options will have the highest theta. They've got the most time value. And options close to expiry, generally speaking, options close to expiry versus options, a similar option, exactly the same option that's got a long way to go to expiry, they are going to have a higher theta. So this is a different, if you like, a different dimension to think about. If you think about an option and as it approaches expiry, what we're saying here is that the impact of time decay is not a straight line. We might have time value with a long way to go. We might have time value that is relatively high and decaying relatively slowly. But as we approach expiry, that rate of decay picks up. It's not a straight line. So this is important. Shorter dated options, shorter options, all else equal, it's a different dimension to what we were talking about before with moneyness, all right? Shorter options, all else equal, will have higher theta in absolute terms, more sensitivity. You know, the reason I keep saying absolute terms, absolute value, is because of course theta is negative. So I don't want people to start saying, well, it might be higher, but because it's negative, that means it's lower. I'm just saying in terms of size, you're going to have higher theta, all else equal, if the option's closer to expiry. So one way to profit from this second bullet point here, one way to profit from differences in theta is through a calendar spread. Now, a calendar spread is a spread where you trade two different options. You buy one, you sell another, but you're really trading the difference in theta between the two options. What you're going to do is you're going to sell options that have a high theta, so sell these options that have that are close to expiry, that are short dated, and to hedge this spread, essentially, to play the spread, you're going to buy longer dated options that you don't expect to decay by quite so much. And if this theta plays out and nothing else disrupts this strategy, then yes, you'll sell options that will go to zero, or will go to, their time value will decay faster than the options that you are holding as a long, and you will profit from that. So that's a calendar spread. And what I've just described there is actually a long calendar spread. When you buy longer dated options with a lower theta in absolute terms, and you sell shorter dated options with a higher theta in absolute terms, everything else the same, if time passes on that, you would expect the time decay on the shorter dated options that you sold to outweigh the time decay on the longer dated options that you've bought, and you are profiting from that position. Now, yeah, that's what you're trying to benefit from. The enemy of this strategy is, so yes, the slides are just re-emphasizing what we've been saying, all right? So we really want to benefit from, we do need a stable market here in the short term. We do need a stable market. What we don't want is real short-term volatility that causes an increase in short-term volatility, which causes the short-dated option to rise in value, because that's the enemy of this strategy. So we do want in the short term, actual stability in the market. If implied volatility for long-dated options picked up looking forward, then that would benefit us as well. All right? If implied volatility picked up looking forward over the longer term, that would have a bigger impact on the longer-dated option. But that's a Vega statement, not a theta statement. So we benefit from a stable market and the time decay playing out. We can benefit from increases in longer-term implied volatility, which will re-rate the longer-dated option higher, up higher than it will do the shorter-dated option. That's a Vega comment there. That's a long calendar spread. Notice that you're going long the longer-dated option here to do the long calendar spread. Okay, so we've seen the long calendar spread. The short calendar spread is the reverse position. A short calendar spread would be selling the longer dated option and buying a shorter dated option. Now this is likely to be less usual, but this is playing in the money options. For in the money options, the difference between thetas is going to be less pronounced. We know that generally theta is higher in absolute terms, or time decay is higher for shorter dated options. But for in the money options, where time value is a small part of the value of the option, and intrinsic value is a bigger part, you might find that thetas are relatively similar. In fact, you might even find an opportunity where there's a lower theta. This goes against the general rule, but there's lower time decay for a shorter dated in the money option than there is for longer dated options. So you're going to sell the longer dated option here with higher time decay, and you're buying a shorter dated option that's actually got lower time decay. All right, this is something that might manifest for deeply in the money options where time value is less of a concern for market participants. But the idea here is you're still buying low time decay and selling high time decay. It is the opposite of the usual theta relationship. Motivation, well, if you're buying short-dated options, if there's a large short-term move in the underlying, then you'll benefit from that in the short term if there's a pickup in actual volatility, or if there's a decrease in longer-term expected implied volatility, that will lower the value of the longer-dated option after the shorter-dated option has expired. Both of these will benefit your trade. And don't forget, this does rest on the fact that you've found you found a difference in thetas here, where you're buying the lower time decay and you're selling the higher time decay. Okay, finally on to Vega. Vega, as we know, is the sensitivity of an option's price or value to a 1% change in volatility, or what's priced into it. We know there's a positive relationship between volatility and option prices, and that is if you're long options and volatility goes up, that's good news for both calls and puts, because the underlying has got more chance of moving more in your favour, up for calls and down for puts. The highest Vega options are at the money options. You'll remember that at the money options have the highest time value. Time value is related to what could happen between now and expiry, and of course volatility is a key, is a crucial component of where the stock could move now between now and expiry. So it's no surprise that at the money options have the highest Vega. And you might remember the strategy that we use to play volatility. It's the straddle. The straddle is being a long volatility strategy. We remember that it plays volatility. It goes long volatility, and its payoff is a big V for volatility, going long a call and long a put with the same underlying and the same strike and expiry. Volatility is a straddle's best friend, and that's its payoff as well. If the underlying shoots up, the call pays off. If the underlying shoots down, the put pays off. But prior to expiry, we're really playing that the market re-rates their perception of volatility to agree with your view that volatility is going to be higher than what was previously priced in. In other words, what you're really doing here is you're buying options with low implied volatility. Low implied volatility that you think is going to be re-rated up by the market. When the market re-rates that up, the Vega, sensitivity to changes in implied volatility, causes premiums to rise. This is not a directional play. Given that you're buying calls and buying puts, you can set this strategy up to be delta neutral. In other words, you've got no exposure on direction, but you have got the exposure on changes in volatility. And of course, the enemy of this strategy is time decay. If nothing happens, if that volatility does not come to pass, if it's not re-rated upwards by the market, then your options will just decay and you'll fall into the bottom of the V, which, don't forget, is the worst thing that can happen. Okay, so we've discussed the profits and losses of a straddle in a previous model, but all we're doing here is re-emphasizing that and talking a little bit about exposures prior to expiry.